So let's talk about inflation, but forget just surviving it. Today, we're going to talk about building a portfolio that actually thrives when prices are going up. Ready? Let's get into it. And you know what? It's one of the most destructive forces out there. It's not just some number you see on the news. Nope. It's more like a silent thief, slowly, steadily, eating away at your hard-earned money, year after year. So the big question is, what are you going to do about it? Okay, so here's our game plan. First, we're going to really understand the enemy. Then we'll bust some old myths that just don't work anymore. After that, we'll get into the real secret weapon, pricing power. We'll look at how to tell the good companies from the bad, and, this is a good one, we'll talk about why cash might just be your new best friend. And to wrap it all up, we'll build your 2026 inflation-proof portfolio. All right, let's kick things off by getting crystal clear on what we're really up against. Because honestly, understanding this is absolutely critical right now. So, inflation really just boils down to two main things. First, you've got cost push. That's when it just costs more to make stuff. Supply chains get messed up, oil prices shoot up, that kind of thing. Then there's demand pull, which is even simpler. It's basically too much money chasing too few goods, and that just bids up the prices for everything. And guess what? Right now, we're getting hit with a nasty mix of both. And this is why inflation is so dangerous. It's sneaky. It feels slow, almost unnoticeable day to day, but the long-term effect, it's absolutely devastating. Just look at this. You take $100,000 and you just let it sit. At 5% inflation in just 10 years, that $100,000 will only buy what about $61,000 buys you today. Think about that. You've lost almost 40% of your spending power without spending a single penny. It just vanished. Okay, so to build a portfolio that actually works for the future, we have to do something really important first. We have to forget the lessons of the past. Seriously, the old playbook, it's broken. It's time for a new one. So what's the first myth we need to bust? Gold. Oh yeah. The minute people hear the word inflation, they just flock to gold. But here's the thing. Some of the smartest investors on the planet, guys like Buffett and Munger, they say it's a trap. And the reason is simple. Gold doesn't actually do anything. And this right here really shows you the difference. Think about it. A business is a productive asset. It actually makes something. It generates cash. It reinvests that cash to grow bigger. It's a living, breathing thing. Now, look at gold. It's an unproductive asset. It just sits in a vault. Its value is entirely dependent on you finding someone else, the so-called greater fool, who's willing to pay you more for it down the line. See the difference? One creates wealth, the other just hopes to transfer it. Okay, so you're thinking, fine, gold is out, I'll just buy stocks, right? Well, not so fast. It's not that simple. History actually shows there's no automatic connection between inflation and stock prices going up. Just buying an S&P 500 index fund and hoping for the best, that's not a real strategy here. It turns out the kind of business you own, well, that's everything. And that brings us to what might be the single most important idea in this entire explainer. Seriously, if you can really wrap your head around this next concept, you're going to be way ahead of the game. So what is it? It's called pricing power, and honestly, it's the holy grail for investing in an inflationary world. Think of it like a company's superpower. When their own costs go up, materials, labor, shipping, a company with pricing power can just turn around and raise their prices to cover it, maybe even add a little extra on top. And you know what? Customers don't blink. They just keep buying. And the crazy thing is, it all comes down to something really simple, a strong brand. Warren Buffett calls it having share of mind. And it's so true, right? When you're thirsty, what's the first thing that pops into your head? For a lot of people, it's Coke. When your family wants to watch a movie, you think of Disney. You're not really thinking about the price. You're paying for the certainty, for the brand you know and trust. Okay, let's make this super concrete with a classic example from Buffett. Imagine a crazy scenario. 100% inflation overnight. Everything costs double. Now, you've got See's Candy. It's a capital-light business with a killer brand. What do? They just double their prices. Boom, their net income goes from $2 million to $4 million. They've actually become richer in real terms. Now, let's look at Boring Square Company. It's a capital-heavy business, like a big manufacturer. They raise their prices too, but here's the catch. All that new money they make gets immediately eaten up by the now doubled cost of replacing their giant factories and all their equipment. So what happens to their net income? It stays flat. See that? One company is creating real wealth, while the other is just running on a treadmill, going nowhere. So it becomes pretty clear what our job is, right? We need to find the C's candies of the world and stay far, far away from those capital-heavy money pits. So let's break down exactly how you spot the difference. And this quote just nails it. The absolute worst kind of company to own when inflation is high is one that needs tons and tons of capital just to stay in business. Think about an airline that has to keep buying new planes or a factory that's constantly replacing machinery. For them, inflation is a total nightmare. Every single dollar they earn gets plowed right back into the business at higher and higher prices, leaving absolutely nothing left for you, the shareholder. And you can see the difference so clearly here. On one side, you've got these beautiful, capital-light businesses. Think software, like Microsoft. They can sell another million copies of their software, and it costs them practically nothing. But on the other side, you've got the capital-heavy players. An airline wants to serve more customers? Well, they've got to go out and spend billions on new planes. It's a totally different game. One model gushes cash when inflation hits, the other one just hemorrhages it. So the big question is, how do you actually find these winners? Well, here's a little checklist for you. You're looking for companies with consistently high gross margins. Think over 40%. That's a huge sign of pricing power. You also want a product that's really unique, a business that doesn't have a lot of physical stuff on its balance sheet, and a model that can get bigger without needing to spend a ton of cash. You find a company with those traits, you might just have an inflation winner on your hands. Okay, get ready because we're about to challenge one of the biggest rules in investing. We've all had it drilled into our heads for years, right? Cash is trash, especially when inflation is running hot. Well, I'm here to tell you that in today's world, that's just not true anymore. Just think about it for a second. For the past decade or so, interest rates were basically zero. So yeah, holding cash was a losing game. You were guaranteed to lose purchasing power every single day. But that world is gone. The game has completely, totally changed. The new power of cash isn't about earning a tiny bit of interest. It's about something much more valuable called option value. What is that? It's the incredible strategic value of having flexibility. It's the option to act when everyone else is panicking. When markets are crashing and great assets go on a fire sale, the person with cash, they're king. They have the power, the option to scoop up amazing companies for pennies on the dollar while everyone else is being forced to sell. And this isn't just a theory, the numbers back it up. Take a look. A 10-year T-bill, that's basically as risk-free as it gets, is yielding around 4.5%. That's 3 times what you'd get from the S&P 500's dividend yield. And it's almost keeping up with our target inflation rate. This is huge. For the first time in a very long time, you are actually paid to wait. Cash is no longer a melting ice cube. It's a strategic yielding asset that gives you incredible firepower. All right, we've covered a lot of ground. We've gone through the theory, we've busted the old myths, and we've identified the secret weapons. So now, let's put it all together. Let's build a concrete, actionable plan that you can actually use. Here it is, your 4-step portfolio audit. I want you to go through every single thing you own and ask these questions. Step 1, be brutally honest with yourself. Does this company have real pricing power? Step 2, is it a capital-light business or is it a capital-heavy money pit? Step 3, dig into the numbers. Are those gross margins consistently above 40%? And finally, step 4, reevaluate your cash. Stop thinking of it as dead money and start seeing it for what it is, your strategic dry powder, just waiting for the perfect opportunity. And really, that's the question you have to ask yourself. The world we lived in for the last decade, that crazy zero interest rate world that rewarded any and every speculative bet, that's over. The next decade is going to be different. It's going to be defined by inflation and the real cost of capital. And it's going to reward real, durable, profitable, capital-light businesses. So the only question left is your portfolio built for the last decade, or is it built for the next one?